Hello, good evening. Thanks for coming out on this gorgeous June evening. I can see looking around the room that not all of you received the invitation to the after party at Tramp. Walking past Lippmann's just now, I noticed it's still open if anybody wants to hire the appropriate wear. But anyway, let's get on to the question at hand, which is the new art of central banking. A lot of new words have entered the central banker lexicon in the past few years since the financial crisis, and we're going to spend some time this evening. Somehow I'm going to try and manage 2 feats, which is to explain these new ideas and try to keep you awake in this evening. So I don't know whether I'll manage both or not, but I'm going to try and precariously achieve both objectives, which, as we know, may result in a trade-off. So in order to keep you awake, I might have to do a less good job of explaining. If I do a really good job of explaining, it might put you to sleep. So we have to work out exactly which point on the trade-off I'm going to end up at tonight. Quantitative easing, macroprudential instruments, forward guidance are all ideas that have been running around the media, running around central bank circles since the financial crisis, and our, let us say, sclerotic attempt to recover from it over the past 6 or 7 years. Central banks have tried to manage a similar feat as I'm trying to do in terms of trade-off. Because what they're trying to do is both to learn from financial markets and manage financial markets. It's a difficult trick to try and accomplish. The more that you manage, the more that you tell them where things are, the less you can learn in terms of what they really think about things. And the more that you could learn, you want to learn from them, you want to expose them to criticizing or making views that don't fit with those of the central bank, the less you're managing them. So it's that sort of problem that central banks, I guess, have always had, but I think has been brought into sharp relief by this crisis. For those of you who've been following the lecture so far, this is the final of 6, so I'm going to try and make some points in sum up at the end, but I also want to leave some time for questions. That's also part of my attempt to make sure people stay awake over the next 50 minutes or so. And that may draw upon anything I've talked about in the course, or indeed anything I mentioned this evening. Remember, we're coming on a long journey, those of you who started on the night of the Scottish referendum last September, to come and listen about the standardisation of money. We then thought hard about the use of monetary policy and financial policy in the Great Depression. We then went on to think about the problems of monetary policy in the post-war period, and the lessons that were learnt in the great inflation and disinflation of the 70s and 80s, and the mirage or chimera, if you will, of what a lot of people call the Great Moderation, a phrase which I hate, and I prefer the term long expansion, of the 90s and early noughties. Of course, this ended abruptly with a financial crisis, the aftermath of which we're still living through, and recovery from which is nowhere complete as we speak. There is a recovery of sorts, and I'm glad of it, but it's not complete. We cannot say that we're back to normal times. And it turns out that managing this process of return to normal times not only involves analysing the form of equilibrium we're in, which is arguably a low growth, low inflation, low interest rate world, but also trying to work out how we manage the economy back along some transitional path, let's call it a recovery path, back to normality, if we can get there. And normality, what do I mean by normality? I defined it, I think, in earlier lectures. Normality, some state of the world in which we're not far from some notion of long-run trend growth, 2% per head per year, and in which the economy has small perturbations around it, and interest rates are moved regularly, slightly up or down. Some of you may remember that world. Most of you are old enough to remember it. It wasn't very long ago. It was 10 years ago. But it was a world in which we thought we'd always inhabit. It's one that we are still some way away from inhabiting again. So we've got not only the nature of the equilibrium we're currently in, which is a not very good equilibrium, a bad equilibrium, but also trying to manage our return, which is precarious and going to be quite long-lived, that return. It's going to take quite some time before we get back to that state of normalcy. Okay, let me go through some points or outline of arguments that I'm going to present in front of you in the next few minutes. I'll go backwards and forwards across some of these ideas, and I hope that it's all reasonably clear. Monetary policy, as we talked about in the previous lecture, turned out to be constrained at the zero lower bound. That means, in a sense, interest rates, it's hard to get them palpably below zero for a long time. That means if there's a large enough shock to the economy, where ideally you want interest rates to go negative, you may find you've run out of ammunition. That's what we really mean by the zero lower bound on interest rates. You kind of want them to go lower because there's been a large enough shock, but you can't because it's kind of hard to get a nominal thing like an interest rate far below zero. Now, of course, I know that some bonds out there are trading at slightly negative interest rates, but they're nothing like as negative as you might have wanted, or indeed may need at some point in the future were there to be a large enough shock. So I'm talking about a different world. So how do you influence financial prices and interest rates when you can't move the price anymore? Well, you start mucking around with quantities. Maybe you inject money into the economy, in this case central bank money, in this case exactly reserves, and maybe through an effect of buying those of using those reserves to buy assets, such as government bonds or other forms of assets, you may provide support for their prices that affects their interest rates. And these are open market operations that, of course, is quantitative easing. We know that fiscal policy, certainly from the Keynesian revolution of the 1930s and 40s, we know that it has a role in helping aggregate demand stabilize over the business cycle. If there's a shortfall, we look for fiscal policy to try and help us out a bit, get us back to equilibrium. But fiscal policy, it turns out, has a number of other obligations. It might help recapitalize banks, for example. It might buy banks such as the Royal Bank of Scotland. So it's a fiscal backstop against lots of other bad things happening. And in that world, you might find that it runs out of ammunition more quickly than you might think, because you may want to keep the ability to issue more debt for further bailouts and further interventions in financial markets. In that world, fiscal policy has a number of other obligations it has to consider other than simply helping aggregate demand. We learnt again that banks are maturity transformers, and that means that they borrow short and lend long, and they, over the business cycle, tended to have insufficient liquidity and capital in the event of risk aversion or potential losses. And one way to try and deal with these in the return to normalcy and in the world of normalcy is to think very hard about ensuring that banks have more liquidity than they had in the long expansion and more capital to help them deal with the natural problems that may result when you have a balance sheet that borrows short and lends long, and a balance sheet that's always managed in the presence of risk, a world in which any decision may go wrong and you may need capital to back it up. The balance sheet operations carried out by central banks expanded both the size and the composition of the central bank balance sheet, but by buying long-term bonds and swapping them for reserves, they changed the duration of the financial markets holdings of assets and changed their liquidity. So think of a portfolio that has a lot of bonds in. If the bonds are sold back to the central bank, that portfolio now has reserves or central bank money in rather than bonds. The portfolio itself is now of a shorter duration than it was before, and also has a lot more liquidity in it than it might have had before. If the portfolio manager thinks that liquidity is in excess, more than they may wish to hold, they may wish to reallocate that liquidity across other financial assets, and therefore providing some support for them. So you may see some of that excess liquidity making its way into other assets and providing general support for the economy. These operations involve the issuance of short-term debt fiscal instruments, either interest-bearing reserves or treasury bills. And these monetary fiscal operations, because if you're issuing reserves that pay interest or T-bills that pay interest, these are fiscal instruments on which the government is going to have to raise taxes at some point in the future to pay them back, can hedge liquidity in the way that I've just described. But if there was significant sovereign risk, so if the underlying instruments issued by the government were ones about which we had credit risk, there are countries I could name that have significant credit risk attached to them, but today I shall avoid being politically incorrect for once. It would be hard for those governments and those central banks to carry out these operations. So it goes back to my second point. In order to carry out these operations, it turned out to be a significantly greater constraint on fiscal policy than we might have thought if we were only worried in generating aggregate demand from time to time. If we want to ensure that financial markets will buy and sell government debt, we need to ensure that they're still demanding it without large fluctuations in the price. So the threads are central banks can operate in a significant way in financial markets by buying and selling assets. Central banks or fiscal financial policy organizations may want to think about macroprudential instruments to constrain financial intermediation in a way so that the business cycle isn't exacerbated and maybe attenuated. And fiscal policy looks as though it may not operate in an unconstrained manner because it has additional obligations attached to it. So we have the threads here of a different policy nexus than the one that we were looking at in the noughties. To remind you there, a separation principle was in place. A separation principle said monetary policy can move a short-term interest rate to hit an inflation target. The financial sector, because it's forward-looking and wise and won't want to go bankrupt, won't do risky things and will look after itself. And fiscal policy, all it has to do is worry about is keeping debt at about 40% of GDP. A simpler world, a triumvirate that was happy in the noughties, but a triumvirate that was storing up large numbers of problems for us in this decade and beyond. We may have to find more role for coordination across this triumvirate, and that's where I'll end up this evening. Now, as we often say to our students, there's nothing new in economics, it's just the answers are sometimes different, the questions are mostly the same. And Ralph Hawtrey, writing in the interwar period, looking at the problems that had been thrown up by gold standard exit and the problems of interwar boom and bust, writes in his book, The Art of Central Banking, and for war you could replace financial crisis. The result has been not merely that the world is insufficiently prepared to deal with the new problems of central banking which have arisen in the years since the war, but it has failed even to attain the standard and wisdom of foresight that prevailed in the 19th century, he argues. Moreover, they should endeavour, central banks, to adapt their measures of credit regulation, for which we can read macroprudential instruments, as far as their domestic position permits to any tendency towards an undue change in the state of general business activity. An expansion of general business activity of a kind which clearly cannot be permanently maintained should lead central banks to introduce a bias towards credit restriction into the credit policy which they think fit to adopt, having regard to internal conditions in their own countries. There's also a case here, he argues, for international coordination as well, which we might think about when we think of the European problem in particular. And on the other hand, he goes on to argue, an undue decline in general business activity in the world at large should lead them, central banks, to introduce a bias towards relaxation. And that's one we certainly see in place at the moment. In pursuing such a policy, the central banks will have done what it is in their power to reduce fluctuations in business activity. So he has regard a much broader state of affairs of central banking than worrying necessarily about bank rate, something more broadly concerned with the overall supply of credit to the economy. Now, the traditional monetary transmission mechanism is a chart that you would have seen. This was reproduced from a report to the Treasury Committee presented by the Monetary Policy Committee in 1999, and you see a mechanism here which goes from the official rate to a constellation of market rates, asset prices, house prices, stock prices, other forms of asset prices. It may influence expectations and confidence, that X factor that seems to be so important, particularly when politicians can't deliver the growth that they promised. It's all the fault of people's confidence, they say. Or indeed the exchange rate. The exchange rate has been a particularly important form of adjustment for the UK economy. The exchange rate can move in a direction to help promote exports or indeed prevent excessive imports from time to time. This affects domestic demand or net external demand, and that affects total demand. Total demand as a relationship to total supply in the economy, both currently and in expectation, gives you a level of domestic inflationary pressure. If we throw in import prices, we get overall CPI. CPI, consumer price indices, are a combination of domestic and overseas inflation, as we saw in the previous lectures, and that leads to inflation. So there's a mechanism there that's mostly about the real side, mostly about demand, mostly about supply. And there's not a lot in here, is there, about banks or money in particular. Now, of course, banks and money are in there. Credit creation is part of the process. Clearly, the financial markets are setting the constellation of market rates that I've described. But as I've discussed in previous lectures, the way that they create that constellation of market interest rates may not at all times and in all states of nature be strictly proportional to the official rate or bank rate that's set. It may disconnect. Financial markets may be subject to exuberance, may be subject to excessive confidence, they may be subject to herding, all areas of research which are heavily or hotly or indeed widely pursued at our universities. And so even though there's the role for the financial markets, the financial sector, the banks are not articulated there, I think underlying this process is the view that the way that they behave will both be predictable and stable, so that given changes in the official rate will bring about stability in the economy through some control in the rate of inflation. Now, we've talked about macroprudential instruments and we've thought about the extent to which financial sector may disconnect. Now, if that's the case, then this kind of story is not complete. It's something that needs to be fleshed out more. What we've seen over this long period, I'm going to turn to my left just to see if so the left-hand side, you can see a red line and a blue line. Red line is bank rate. Can't quite see the numbers there, but essentially it's from the inception of the Bank of England all the way up to 2009 when rates hit 0.5%, and they've been there ever since. And the red line shows you the fluctuations in bank rate. So we have had a previous long period where bank rate didn't move very much at all. The blue dotted line, which you may just be able to see, are long-term rates. And long-term rates are mostly an average of current and expected short-term rates. And in fact, on this chart you can see it almost looks like a moving average through the set of short-term rates. And the reason I put this up to talk about long-term rates is that later on we're going to talk quite a lot about long-term rates. So I want you to have an idea of the kind of models that we have when we start thinking about pricing long-term rates. If I'm going to think, what is a long-term rate? Well, a long-term rate is going to be today's short-term rate plus my understanding of the process that determines the short-term rate from now till the maturity of the bond that I'm buying. And that view, or that moving average process, is going to give me my price for my long-term rate, very approximately. Give or take some risk, give or take some views about where long-term rates need to clear the market for savings and investment. And indeed, to a broad approximation, that's what we see. The right-hand chart is an attempt to show you how policy activity has increased, but also the extent to which bank rate has fluctuated a lot more in the 20th century. All I do here on the bottom, the x-axis here is time. The x-axis here is just, we only move along every time interest rates move. So we get from the beginning of the Bank of England 1694 to today, as we do here, but we only move along every time interest rates move. And we get about halfway in the last 100 years. So we've done a lot more in terms of moving bank rate in the last 100 years than we did as much in the previous 200 years. So we've become a lot more active. And that fits in with the story I've been telling, a story in which we had an analytical framework by which government could take responsibility for the level of output growth and inflation. Having taken responsibility for it, the political economy of it was that we began to expect them to do this for us. And say, look, hang on a minute, growth is low, it's your fault. Hang on a minute, inflation is low, it's your fault. Do something about it, otherwise we won't elect you. We'll throw you out, we'll get someone else in. Or we'll throw you out and we'll join the euro. Or we'll throw you out and we'll get the Bundesbank to run monetary policy for you. These are all the points that we've thought about. If they cannot credibly commit to a nominal framework that delivers reasonable levels of growth and stable levels of inflation, we may think of alternate mechanisms that will. The debate on Europe is only a manifestation of the same debate. If we can't do it properly here, we can ask someone else to do it for us. What we can see, of course, is that this chart on the right-hand side brings into sharp relief, I think, the errors of the 70s. Look at the wide fluctuations and the frequency of the fluctuations. 70, 71, we're coming off Bretton Woods, we're trying to learn how to run a nominal anchor that's not fixed to gold. When we can control the rate of money issuance, and we can make mistakes and be responsible for our mistakes. And we see a long period by which mistakes are made, cycle after cycle. We're losing monetary control and trying to find a stable nominal anchor. And indeed, the so-called Great Moderation or long expansion period didn't last very long at all. Certainly if we look back to the 19th century, things blew up very, very quickly. And we go back and remind ourselves of Hawtrey's point. Could it be the central banking was too narrowly focused in this period, not thinking hard enough about the financial settlement and the way that was promoting excessive volatility in our system that was revealed once the financial crisis came around? These are points that I have touched upon in earlier lectures, but I'm going through them again. And we've talked as well about the simple monetary policy framework. I shall do this quickly. If it's too quickly, I suggest you go back a couple of lectures and you can see it explained again there. But we have a market clearing real rate here. Every time inflation increases, this real rate stays the same because the Fisher equation just says nominal interest rates increase with inflation. So that's just an equilibrium in our economy. At every real rate here, savings and investment are clearing. If we have an inflation target, let's suppose it's positive, the long-term nominal interest rate will be at this point here, according to our inflation target, plus the real rate. The policy function, as we saw in the long expansion, particularly after the adoption of central bank independence, was if there was positive inflation pressure above the inflation target, we raise rates here, so real rates have gone up, they're above this line. Raising real rates bears down on consumption and investment, brings down demand and brings down the level of activity to here, and interest rates back to this point. Similarly, for negative shocks, it happens in reverse. Real rates are lowered, this brings forward consumption and investment, adds to aggregate demand, leads to positive inflationary pressure, and we head back to this long-run equilibrium. If we're stable, if we're in a long expansion that is generating stability, our expectation of the long-term rate, this moving average thing, will be about 4 or 5%. 2 and a bit percent growth, 2% inflation, plus a little bit because it's RPI, 2.5%, plus a little bit for a little bit of risk, so you get a long-term interest rate of 5%. Short-term rates are just jumping up and down around this long run, so the yield curve is upward sloping in a slight downturn, downward sloping in a boom, but the long-term rate is around 4 or 5%. Very easy. Of course, you see the problem. If the shocks are large enough, we hit this low zero bound. But here, interest rates are at zero, but if inflation continues to fall, because interest rates can't fall, real rates start to rise. If real rates start to rise, where's the incentive to bring forward consumption and investment? If real rates are rising, we're going to continue to save. We may end up in a trap, in a low interest rate, low growth, low inflation trap. Sound familiar? It's possible. Could it happen? Not here? Not now? Let's go on. Want me to think about the policy rate, as I've said, is real growth plus inflation. That gives you nominal GDP growth, which is the blue line here. And you can see that the blue line tracks the policy rate pretty well over our inflation targeting period. And it brings into relief the point that I've just made. For a large enough shock, however that shock came about, my point is the shock itself may not have been large, but the financial structures that we had evolved had become terribly unsafe, in that even a small shock was sufficient to bring about a large response in output. That's the story that we have in 07, 08. Nominal GDP falling by 5% or more, 2008, 2009. Policy rates can't go below zero, and in effect what you see here is a demonstration, this triangle here, of a policy gap. You want interest rates to go lower, they can't because they're difficult to get them below zero. Excuse me. This means you cannot necessarily stabilize this economy. You may end up in a very bad equilibrium because you can't get interest rates low enough. Let me describe that equilibrium for you. I hope you like charts. Lock the doors. Right. So that's the chart we've just seen. Now, so we draw this, and what we can see is there's actually two equilibria in this story. This is our normal world, where long run positive growth, positive inflation, long-term rates are at 4 or 5%, short-term rates hobble around them, bounce up and down them. And here, interest rates go to zero, they stay there for a long time. The constellation of real rates are high. Borrowing is expensive, this confidence is low, all that kind of stuff that's part of a transmission mechanism that might be associated with a recession. And we head to this equilibrium here in which inflation is either negative or near zero. Nominal rates are at naught, but the natural rate is obtained at 2 or 3%. And so there's a few issues here. Is this truly where we are? Is this where we've ended up? Or, if we could just imagine, I won't put this chart up again, another line that carried on this direction here, imagine that, we could get back to A if some real rates could fall. So if we thought instead that this is not just one rate, this is a lot of rates, long-term interest rates, if we can act on those to bring them down, maybe this line continues in this direction here. Because it could be that even though we can't get this actual policy rate below zero, maybe we can make other interest rates behave as though the policy rate has gone below zero or is at zero for a very long time. In that world, we can still stabilize back to that equilibrium. We may not be stuck here. On the other hand, if we are stuck here, we have to think very hard about how we get back to this preferable world. Well, what's the answer? Well, the answer is quantitative easing. And how does that work? Well, first, your central bank, you set up something called the Asset Purchase Facility, otherwise known as a hedge fund, working out of the Bank of England. And what it does is simply borrow £375 billion. I'm sure any of us could do it just by walking to Threadneedle Street and asking. Borrow £375 billion of reserves from the Bank of England, pay bank rate on it, 0.5%, is what the facility does. Use that money to buy bonds that the government has already issued to non-bank financials. So the government has increased the level of debt in response to the financial crisis. That debt has already been bought by non-bank financials. They're holding it on their books. So their portfolios may be too heavy in bonds. So the bank is able to buy these from these non-bank financials. And having bought the bonds, they then sit in the asset purchase facility as an asset. The liability of that asset purchase facility is the interest that has to be paid on the reserves. And having bought the bonds, this asset purchase facility clips the coupon, 3%. Having borrowed at 0.5%, they make a nice turn of 2.5% a year on the £375 billion that have been bought. So, what does that do? Well, the portfolios of the private sector then hold reserves rather than bonds. The APF collects these coupons, which it can keep, and indeed, since I think last year, they've been remitting these profits back to the Treasury, as well as offsetting some of the deficits. Don't want to get into the monetary accounting of that, but we can. That's not the key, I think, to this question. But what you're able to do is, because you've removed bonds from the system, you've reduced net supply, you've raised the price, and by having portfolios out there that are now more liquid than they otherwise would have been, they're not holding bonds, they're holding reserves, some of those assets may get reallocated into more illiquid assets that will tend to raise their prices and promote some positive activity in the economy. That's the story. Now, it's still an open debate about how effective it's been. The point is, it's an operation that's been introduced into the central bank lexicon, an operation that has led to large balance sheets and a composition in the balance sheet that's different to what we've seen before. And how would this work? Well, we're familiar with the ISLM curve, but I want you to imagine here that there's a credit curve here, and what we're saying is that at lower bond rates there'll be more demand for goods and services, so this particular spending equation will clear at higher levels of output. And there's an LM curve here, and higher levels of activity require higher levels of money for transactions, and that can only be affected by having a higher rate on bonds. So you've got an LM curve here and a CC curve here. The operations of reserves, by increasing the money supply, are shifting out this LM curve. That's resulting in lower interest rates and a higher level of activity. But in the end, if spending also starts to increase, the CC curve will increase, and we may not be able to observe any more of the impact on interest rates, but we should be able to observe is a higher level of activity than we otherwise would have seen without these operations. That's the idea. So the mechanism is the following. By increasing reserves, you're increasing the availability of money in the economy. By increasing the availability of money in the economy, you're lowering interest rates. Lowering interest rates promotes greater credit activity and leads to a higher level of output. It's the first stage. If on the same hand, for the same level of money, there's more credit available, more demand for money, interest rates will also rise. So you'll get a world in which we're not quite sure about the interest rate impact, but the impact on output will be positive. And what did we actually see? Well, I point you to the growth rate for broad money after the operations of QE, and there's no real increase in broad money creation. And some people would say that's an argument to suggest that QE didn't work. It didn't lead to banks increasing their lending, didn't lead to an increase in investment through banking involvement. But that's very hard, but the counterfactual is very difficult to work out. Banks are deleveraging, the private sector is deleveraging in this period, and at the same time banks are changing the ways in which they're extending credit. We're changing the mechanisms by which intermediation occurs, making it more difficult, changing the rules, and requiring banks to hold more capital and liquidity against loans that they make. So we might reasonably have expected the growth rate to have fallen by even more. So it could be the case that even though money growth didn't increase to a great extent in the early years of QE, one might argue that the growth rate may have fallen had it not been for QE. What were the bonds that were being bought? Well, I'll just quickly sort of explain this. Public sector net borrowing is at the bottom of this chart, the right-hand side. So this is the flow of debt issued by the state in the years from the financial crisis here. QE starts in 2009, and you can see these are the quantities of debt bought by the Bank of England. And you can see the fraction of debt held by the bank increasing over the period of QE. That gives you an idea, so that by the end of the operation, up to £375 billion of holdings, that's about 30% or so of outstanding public debt. The impact of these was that if you ran a model and tried to understand what long-term rates were, remember they're this moving average idea. If you ran a model, tried to understand what long rates were in 2009, at the depth, 2008, 2009, after the collapse of Lehman's, at the depth of the financial crisis, you actually would have found that UK long rates were far above where you'd expect. There was a risk premium embedded in them. Whether it was because of liquidity or credit, we're not sure. But following the QE operations, see that actually the long-term rate then fell below where you'd expect it to be, given these long-run expectations. So it looks as though the QE operations certainly lowered the bond rate by something between 20 and 200 basis points. And how does that work? Well, the complete market's view of bond pricing is that bond prices would, there'd be a perfectly elastic demand for bond pricing at a price that would represent the present value of the cash flows from holding the bond. To be your view. Therefore, if we change the supply one way or the other, there's no impact on price. It could very well be, though, that if we start to increase the quantity of debt above some level, at that point, concern about the liquidity and creditworthiness of the debt start to become paramount in the views of potential investors. So the demand curve becomes inelastic. And at that point, changes in supply palpably impact on the price. So, you've had a financial crisis, you've had to run up large amounts of debt, you've suddenly got a world in which people are having to absorb more debt than they would have expected, the price falls. Price falls is another way of saying interest rates go up. That's the first stage. QE, by buying back the debt, shifts the net supply back up here and raises the price. So, the operation of QE itself is an admission that pricing assets requires us to understand the shape of both the demand curve and the supply curve for assets. It's not just purely determined by the present value of the cash flows. In other words, risk matters. in this world. And if risk matters, it's something that central banks can operate against through liquidity operations or purchases of debt. Now, bank rate, as I've said before, is but stuck for a very long time. We have the duration of bank rate here. Typically, bank rate gets moved every few months, but once we're below zero, it just kind of stays there for a very long time. That's the bad equilibrium that I've described. And I'll throw open the question for QE as well. As one argument is, does QE work through this supply effect, or does it work through signalling? Now, on the left-hand chart, I show what we would expect long-term rates to be in normal times, even if bank rate were 0.5%. Long-term rates would be about 4.5%, because we're expecting that long-term rate to go back to the equilibrium that I described before. If, on the other hand, in the world that we're in, policymakers have signalled we're in this bad equilibrium and we're going to stay in there a very long time, and interest rates are going to stay down for a very long time, people will change their expectations of where long-term rates are going to be, and long-term rates will fall by a lot more. And you'll get long-term rates of currently where they are. So another way to think about these policies is not so much about the purchases of bonds, but their statements about the rate at which policy rates will return to normal. And here is the crux of a problem faced by central bankers. If I have made statements to say that interest rates will be low for a very long time, and I've got long-term interest rates down, you may think that's a good thing, because that will stimulate the economy. Interest rates come down, mortgages are low, investment is cheap, we're going to invest, we're going to bring the economy back to normal. On the other hand, the very statement that interest rates are going to stay low for a very long time is an admission we're in an economic slump. It's going to tell people if interest rates are down for a long time, we're not going to get back to normal for a very long time. And in that world, aren't we going to have to continue to save and hold off from investment? Because there's not going to be demand out there to meet our supply plans. And this is the problem. The more that we make the case that we've talked down long-term interest rates, are we not also telling people we're not going to get back to normal times? How do we manage the transition? Ideally, we'd want interest rates to be high. But if they went high too quickly, that may bear down on activity and keep us back in this slump. This is the problem that we're facing at the moment. In fact, there are two equilibria, two worlds, a number of possibilities, a number of scenarios. And we need central banks to spell them out and give us a story to explain which one of these cases will obtain and why. In fact, it's all about uncertainty. I want to skip on a little bit. I want to finish a little bit in advance of the final deadline. So, I've talked a lot about the interactions of monetary policy with the zero bound, the relationship between fiscal policy and monetary policy. I want to talk a little bit about financial policy as well in terms of macroprudential instruments. As I've said before, one club monetary policy seems to have been insufficient to prevent booms and busts, and indeed may have played a role in nurturing volatility. The Bank of England's newly formed Financial Policy Committee has asked for extra instruments, counter-cyclical capital ratios. Banks have to hold more capital over the business cycle. Sectoral capital if they're lending too much to property. Why don't you hold more capital against that? A leverage ratio. Maybe we're not going to allow you to have too low levels of capital relative to your assets. And loan-to-income ratios for people who want to borrow. No liquidity or loan-to-value ratios yet, but there's a whole bunch of, or panoply of what we might think of as potential constraints on financial intermediation. I've done some work on this, and those of you who are particularly masochistic may want to look up these papers and read them, but a whole bunches of papers out there, and I'm just at the, in very much in line with other people, who are generally finding that such instruments, in a world in which the financial sector can be detached or disconnected from the real economy, can very well increase welfare and output. Because it sends the intuition is it can reduce the volatility of market premia over the business cycle. It's the kind of story that we get in these models. But overall, macroprudential instruments are untested and little evidence. There's a whole bunch of evidence being presented to the Treasury Committee, and I give a reference there for those of you interested. But let me rather than go through a lot of the minutiae, let me present some ways of thinking about the role of the financial sector vis-à-vis the monetary sector and the extent to which they may or may not work together, the extent to which they may or may not need to be coordinated. That's what I want us to think about. Because I think this is the main problem facing those of us interested in monetary and financial economics over the next decade. I think I've said before, if we were standing in this room 30 years ago, we may have been concerned particularly with high levels of long-term unemployment. I think now the problem facing us is this question of the financial settlement. And I want to present a little schemata to you, and you can start to think about it yourselves and maybe come up with some ideas. So do forgive me some more charts. Now, MPR's monetary policy reaction function, activity, GDP, output, whatever you want to call it, it's all described in that monetary transmission chart from moments ago. And the policy rate. Now, the policy rate essentially follows activity. If activity is low, the policy rate will be low. If activity is high, the policy rate will be high, for the reasons I've just discussed. The central bank or society, or indeed the central bank as suggested by social preferences, as dictated to it by our benign political leaders, may decide on a particular level of activity that's consistent with long-run growth and an inflation target. And that may be the target set for the central bank. If that's the so-called bliss point, the circles represent points that are equidistant away from that bliss point, and therefore the economists call these indifference curves or indifference circles away from there. And ideally, the central bank would want to be at that blue point there if it could. But it may not be able to, may be constrained, and may find itself over here if it can't get there, if there's a constraint operating on it. The constraint could be another line or something, but just imagine this going. Ideally, central bank as well would, if it could, try to push the economy towards its target. Because the central bank doesn't want to write lots of letters, doesn't want to have lots of excuses as to why it hasn't hit the target. It will always have good excuses, but may not want to write its letter every month to the Chancellor to explain why it's missed its target. So it wants to try and get to its 2% target if it can. So you can think about this very much like the stabilising policy reaction function I described about 15 or 20 minutes ago. And imagine that's describing the monetary policy maker. Now, let's imagine there's a financial sector. Remember we talked about the monetary transmission mechanism. So the policy rate gets moved, activity jumps around, and inflation tries to hit the target. That's the kind of story I was talking about the monetary transmission mechanism. Now I want you to imagine there's a financial sector. And the financial sector here is a stabilising. It's a nice financial sector. It's a nice cuddly financial sector. It does what we want it to do. It helps the economy get back to the equilibrium. It's really, it's a Scandinavian financial sector. Let's put it that way. It's something that we all aspire to be in some sense. So here's our central bank. Here's the level of interest rates that it chooses given the level of activity in the economy. This level of interest rates is low. The low level of interest rates raises asset prices, promotes lending in our financial economy. Have it in your head. So it leads to this level of activity by the financial sector. The financial sector gets very excited at these low level of interest rates. So it increases the level of activity. At this level of activity, the central bank can then afford to raise interest rates up to here. Say to itself, oh, there's a lot going on, a lot of property lending, house prices are rising even in Walthamstow, and what I'm going to do is raise interest rates to here. Having raised interest rates to here, the financial sector is still stabilised, it's still frothy, still increasing activity, still increasing lending, asset prices are still high because they're below their interest rates are below their long-term equilibrium, and this economy shoots back to its long-term equilibrium. The financial sector here is a part of the transmission mechanism that stabilises the economy and helps us get back to equilibrium. This is the kind of benign financial sector view that we had underpinning the new Keynesian DSG model. The financial sector is helping us get back to equilibrium because the financial sector can see the constellation of interest rates, provide the right amount of intermediation to help this economy clear at a rate that's consistent with the inflation target and at which savings and investment clear. That's the story. Okay, fine. But our nice little Scandinavian financial sector may not always behave that way. Now imagine a world in which interest rates are low here, interest rates are low, and yet confidence dominates, uncertainty is prevalent in the economy, the financial sector is scared, the financial sector has made lots of losses, when activity is low, its loans have gone bad. Asset prices fall because at these low interest rates, risk premia are high. The financial sector does not intermediate. It reins back on its lending in this world. So in this world, at that interest rate, activity actually falls. As activity falls, interest rate has to fall. As the interest rate falls, that signals to people the economy is in an even worse state. Oh my gosh, we're in a complete depression here. The financial sector constrains even more. It has to hold more capital, do even less lending, have more forbearance, no new loans are offered. And the economy spins off into some horrible trap. A destabilising financial sector. Clearly, we want the financial sector to be stabilising, not destabilising. There's a world in which, of course, we can think about the upside of this, where the financial sector is adding and growing too much, given the level of interest rates. Now, I've drawn the previous charts as though the financial sector has the same preferences are determined by these circles, as the monetary policy maker in a society. But let's imagine the financial sector has different preferences, has a different view about the steady state it would want. It may want more activity than the central bank would want. Now, why might it want more activity? Why might it want to lend more? There may be risk shifting in the world in which the financial sector may not, of course this would never happen, may not bear all the consequences of losses it makes. If the financial sector does not bear all the consequences of losses it makes, the financial sector is risk-loving. It takes on more risk, takes on more lending, carries on with more activity than it should given social preferences. This is risk shifting. Of course, it's something that would never happen, would it? And in that world, the financial sector is trying to aim for some point here. And if these guys couldn't agree, the only point at which there would be no further change, and this is a Nash equilibrium, would be this point here, which would imply higher interest rates than the monetary policy maker would prefer, and indeed a higher level of activity. This is maybe the story of the noughties. People were arguing because lending was frothy, interest rates should go higher, even though inflation was low. Now, how can you avoid that? How can you avoid this Nash equilibrium here? Well, you have to have a political or institutional framework that causes these guys to get together, take their preferable points here, work out, this is called a contract curve, and work out institutional device so they get together and coordinate and remain on that contract curve. It's not terribly stable because these guys are going to want to, if this level of activity persists, the central bank is going to want to put interest rates there. At this level of interest rates here, the financial sector is going to want to do that much activity. So there's got to be a lot of political will to bring about that kind of agreement. And that was lacking with the tripartite arrangement that we had prior to the financial crisis. Nobody wanted to get these people together to get them to do things that will coordinate as closely as possible to social preferences. One way to think about the problem. And indeed, if you can't get them in a room and you can't get them to agree, what may happen over time is the financial sector may get frothier and frothier and frothier. Global real interest rates fall, excessive savings from other parts of the world, financial engineering, globalization of capital, all help the financial sector get frothier and frothier and frothier. And drive out this curve further and further, that increase the benefit from an agreement, but in the absence of agreement, led to interest rates that were not appropriate. So this is our problem. How are we going to work this out as a society? Is the question I put to you. Now, I wanted to talk a little bit, but I want to also finish in 5 minutes about forward guidance. So I'm going to not talk about all the points about forward guidance, but I want to just say a few things, and maybe the best way to talk about forward guidance would be to say, well, how should we be describing monetary policy in a world in which long-term rates matter, in a world in which the debt stock out there that the central bank has bought affects asset prices? The debate has mostly revolved around when the first change in interest rates will occur, rather than the whole path of interest rates. And so there's been extensive debate in the monetary policy literature about the extent to which central banks might help private sector agents adjust back to the proper or normal equilibrium by fully describing the most likely actions that may occur. And the best way to think about this is a chart that hasn't been used, but may well be used one day. At the moment, central bank doesn't provide its own forecast of where the policy rate will be, and doesn't provide its own uncertainty about those paths. Remember I talked about two possible scenarios for the policy rate. One is that we're in the doldrums forever, and policy rates always stay very low and move very gradually up again. And the other is that we move quickly back to equilibrium because we've all suddenly got our confidence back and the banking sector works and we've deleveraged enough. In fact, we don't know which one is going to obtain. They're all possible scenarios. And what might help is if the central banks started to articulate these possible scenarios and gave us some idea as to the trigger points for each of these scenarios. And that would require the publication of a density forecast. Density forecast just means a world in which you've outlined the possibilities for bank rate with some notion of their likelihood attached to them. The darker lines here are more probable, they're like the centre of the distribution. The lighter lines are also possible, but less probable. Just think of it as a density function. And because you've also bought this large stock of debt, you'd also want to tell the markets the world in which you're reducing this debt back to zero, if at all, over some point. Because when you sell this debt back, you're raising interest rates because the price of that debt is falling. And that's another factor in both the fiscal policy arrangement and the financial policy arrangement. So I think what we want is more explanation of what central banks are planning to do. Just so I finish in time for some questions, I'm going to finish with where I think we are. It's not going to be a complete answer as to what the economy will look like and how monetary policy will work. But I think it's about as far as I can go in terms of being safe about the nexus for the next 10 or so years. I don't think inflation targeting can prevent boom and bust. It's clear also that money supply, whether it's narrow in terms of reserves or central bank money, or broad in terms of credit components, matter, as they tell us something both about confidence, lending and spending plans. But by looking at these, it's going to complicate both the short run and the long run level for bank rate as we think about how these different credit components impact upon activity. Financial frictions, the world in which it's more expensive or less expensive to borrow depending upon the efficiency of the financial sector, make capacity judgments very hard because they impact on both the supply and the demand side. We know that fiscal policy underpins aggregate demand, but because it supports fragile financial institutions, there are always further restrictions in force that we have to think very carefully about. What would happen if the euro went into further turmoil or even broke up? What would that do to the banking sector? What kind of constraints might that play on fiscal policy? And also, what kind of capital would banks have to hold against that possibility? These are the kind of scenarios we have to think about if we're going to deal with the kind of shocks that an economy may be subject to over the long term. Debt, even at 90 or 95% of GDP, is going to take 10 to 15 years to get back to 30 or 40%. It's not going to disappear very quickly in the absence of a default. Sensible application of liquidity and capital targets do seem to be able to reduce business cycle variance, but because they may well impact in a permanent way on lending rates, they may even lead to some permanent loss of output. It can be very hard to judge those two over the business cycle. And so I'm left with a rather unsavoury message in the end. I think plotting the policy path is going to be considerably more complicated, and as a result it requires more explanation, not less, than we've had in the past. So we're all going to have to get savvy to what central banks are doing. Thank you.